short $8.4 billion of credit default swaps related to mortgages or financial companies.
Michael Burry just dropped another bomb. The man who predicted the 2008 crash now says in 2026 they're and no, this isn't just fear-mongering, because when you look at what's happening under the surface, the debt levels, the asset bubbles, the AI hype, and a market that's running on fumes, you'll realize this might be the most dangerous setup we've seen since the great financial crisis. But before you panic, listen carefully, because in this video, you're gonna learn what Michael Burry is actually warning about, why the traditional 60/40 portfolio may be dead, the truth about bonds, gold, and Bitcoin in this new economy, and exactly how you can protect your money going into 2026 without gambling it all on hype. So let's break it all down. Because once you understand what's really going on, you'll see why the system is quietly unraveling. And more importantly, what you can still do about it before it's too late. To understand why Michael Burry is sounding the alarm again, we need to look at the bigger picture. Because on the surface, things look fine. The stock market is up, AI is booming, the Fed is hinting at rate cuts, and investors, they're back to being greedy. But here's the problem. Underneath all that optimism, the foundation is cracking. US national debt is exploding past $34 trillion. Bond yields have collapsed to historic lows, which means the so-called safe part of your portfolio is quietly bleeding. Inflation, still lurking and higher than the government wants to admit. Your money, losing value every single day. And yet, people are piling into risk like nothing ever happened. Remind you of anything? Yeah, 2006 looked pretty similar too. And that's exactly why Burry's warning is different this time. Because he's not just talking about one bubble. He's talking about a system-wide failure waiting to happen. And that brings us to the first major problem, the death of the 60/40 portfolio. For decades, the 60/40 portfolio, 60% stocks, 40% bonds, was considered the gold standard of investing. It was supposed to balance risk and reward. If stocks went down, bonds went up. Simple, effective, safe. But not anymore. Today, both stocks and bonds are moving together and not in a good way. When inflation hit, bonds crashed instead of protecting your portfolio. And stocks? They've been on a roller coaster that's getting harder to predict. So what used to be the safe bet is now a ticking time bomb. They're the ones who decide when to print more money or raise rates to control inflation. Right now, we're in a weird spot. The Fed's juggling high inflation, rising debt, and slowing economic growth. If they raise interest rates too fast, it could trigger a market crash. If they keep printing money, it risks runaway inflation and devaluing the dollar. Michael Burry warns that this balancing act is more fragile than it seems. Because the US debt just hit $40 trillion a number, so huge it's almost impossible to grasp. And this debt isn't just a number on a spreadsheet, it affects everything from your mortgage rates to how much groceries cost. So why should you care? Because the Fed's moves can make or break your investments and your financial future. But it's not all doom and gloom. There are strategies to protect yourself, and we'll break those down in the next parts. Stick around. This is where things get interesting. So, what are the biggest risks we face in 2026? First, there's the risk of a market correction or even a full-blown crash. When debt levels are this high and inflation is unpredictable, markets can get volatile fast. Second, rising interest rates could squeeze corporate profits and consumer spending, slowing economic growth. Third, there's the risk of bubbles, especially in sectors like AI, tech, and crypto, where prices might be artificially inflated. Michael Burry, famous for predicting the 2008 crash, believes these risks aren't just possible, they're likely. But here's the key takeaway. You don't have to predict exactly what will happen next to protect yourself. Diversification and a strong plan can help you survive and even thrive no matter what. We'll dive into those strategies soon, but first, it's important to understand the environment we're dealing with. Let's take a quick look back. History shows us that markets always go through cycles, booms followed by busts. The 2008 financial crisis, the dot-com bubble burst, the 1987 crash, all painful, but all followed by recoveries. What's important is how investors reacted. Those who panicked and sold at the bottom lost big. But those who stayed calm, stayed invested, and kept a diversified portfolio saw their money grow over time. Michael Burry's prediction isn't meant to scare you, it's a warning to be prepared. Because when you understand history, you're better equipped to handle what's coming. Next, we'll talk about smart strategies to protect your investments and reduce risk in volatile times. Don't go anywhere. So, how do you protect yourself if Michael Burry's prediction comes true? First, diversify. Don't put all your eggs in one basket. Spread your investments across stocks, bonds, gold, crypto, and other assets. Second, consider portfolios designed to weather all market conditions, like Ray Dalio's all-weather portfolio. It won't make you rich overnight, but it helps reduce risk and smooth out volatility. Third, avoid trying to time the market. Statistically, you're far better off investing consistently over the long term than trying to guess when to jump in or out. And finally, keep your emotions in check. Investing isn't about quick wins, it's about patience and discipline. Next up, we'll dive into how adding Bitcoin could impact your portfolio and whether it's right for you in 2026. Stay tuned. Now, let's talk about something that's been shaking up the investing world: Bitcoin. While it's true we don't have decades of data like we do with gold or stocks, Bitcoin has already shown incredible growth potential. Research shows that even a small allocation around 2 to 2.5% can boost your overall portfolio returns significantly without adding much extra risk. For example, a 2% allocation to Bitcoin has increased returns to almost 17% annually in some backtests, which is quite impressive. Even better, studies from major firms like Fidelity and Bitwise confirm that holding Bitcoin long-term can enhance returns while keeping volatility manageable. But remember, Bitcoin is still young and can be volatile, so it's important to treat it as a small part of a balanced strategy, not your whole portfolio. If you're thinking of including Bitcoin, consider a dollar cost averaging approach, buying small amounts regularly to smooth out the price swing. With that said, Bitcoin could be an important part of your strategy in 2026 and beyond. So, to wrap up everything you've learned in this video, we discussed why Michael Burry's prediction for 2026 has everyone worried, especially about the fragile state of the economy and markets. You saw how market returns are rarely average in the short term and why a long-term mindset is key to successful investing. We broke down Ray Dalio's all-weather portfolio, its strengths and limitations, and why diversification remains your best friend. Then, we explored how adding a small allocation of Bitcoin could potentially boost your returns without adding much extra risk. Most importantly, you learned the crucial investing lessons. Don't chase headlines, don't time the market, diversify wisely, and invest with a long-term horizon. But remember, this is only the beginning. To truly protect and grow your wealth, you need to keep learning about evolving market trends, economic shifts, and smart strategies. That's exactly what the next video in this series will cover: how America's soaring $40 trillion debt impacts your investments and what you can do about it.